Welcome, everyone, to this episode of Hardcore Financial and Business Analysis. Just recently, global capital markets witnessed one of the craziest and largest capital feasts in human financial history. On June 12, 2026, Elon Musk's space exploration technology company, SpaceX, officially went public with its U.S. stock ticker set as SPCX. Before its official listing, the record for the largest IPO in the global financial market was held by Chinese e-commerce giant Alibaba, which raised $25 billion 12 years ago in 2014. But this time, SpaceX shattered that ceiling right out of the gate, raising a staggering $75 billion from the global market in this IPO. Its initial valuation at market open reached a whopping $1.77 trillion, parachuting into the U.S. stock market to surpass Musk's other star company, Tesla, and becoming the seventh largest megacorporation in the U.S. by market value. However, just as retail investors and frantic Musk believers thought SPCX would forge ahead relentlessly, even driving the stock price up to $225 intraday, and pushing the total market cap past a peak of $2.3 trillion, a Wall Street black swan arrived without warning. Less than 2 weeks after listing, strangled by both a broader tech stock correction and rumors of massive internal bond issuance, SpaceX's stock price abruptly reversed course, triggering a panicked 16% single-day crash. The stock price pierced through multiple psychological support levels, skyrocketing down to around $156, a violent retracement of over 30% from its absolute peak. What does this mean? It means that within a matter of days, this company, which carries humanity's dreams of Mars, saw over $4,000 billion of its market value instantly evaporate from virtual digital tickers. Countless retail investors who bought at the top and trend-following institutions were instantly wiped out in a bloodbath. Alongside this stock price roller coaster, Elon Musk's personal wealth also underwent a thrilling paper evaporation. When SpaceX's stock peaked, Musk, as the founder holding an absolute majority of shares, saw his net worth temporarily break through $1.2 trillion, making him the first true trillionaire in human history. But, with this ruthless 30% pullback, his personal fortune shrank instantly to $957.0 billion, falling back below the trillion-dollar milestone. Facing such an absolute bloodbath, major short sellers and clear-headed analysts on Wall Street began to publicly question, how on earth can a story stock trading at a price-to-sales (PS) ratio approaching 100 times justify a $2 trillion valuation? To put this in perspective, tech and retail giants in similar categories trade at much lower multiples. Apple's PS ratio sits around 10 times, Tesla is around 15 times, and even NVIDIA, the dominant king of AI chips, trades between 25 times and 30 times. Yet, the moment SpaceX listed, its PS ratio crashed the party at a terrifying height of nearly 100 times. This is no longer valuing current performance. This is putting a price tag on next-century science fiction. So, behind the largest IPO in human history, what kind of cash crunch is Musk actually hiding? How many interlocking capital gains are buried within that seemingly flawless prospectus? Today, through the exclusive disassembly of SpaceX's hundreds of pages of prospectus, combined with the latest web-wide financial data and Wall Street insider trading drama, we will peel back the layers of this cosmic capital gain. To understand why SpaceX could be worth over $1 trillion and why it plummeted so quickly after going public, we must first gain a crystal-clear understanding of its core assets and business structure. According to the prospectus SpaceX submitted to the U.S. Securities and Exchange Commission, SEC, the document is uniquely drafted, barely resembling a traditional financial report, but looking more like a hardcore science fiction novel complete with colored illustrations. Instead of dense spreadsheets right at the start, the prospectus opens with a grand narrative. Our mission is to make life multi-planetary, explore the nature of the universe, and extend the light of consciousness to the stars. After setting the emotional stage, the prospectus clearly divides SpaceX's vast commercial empire into three main pillars: space, connectivity, and artificial intelligence, AI. First up is the crown jewel segment that captures humanity's imagination, the space division. Simply put, this area manufactures massive rockets, launches satellites, and transports astronauts. SpaceX's monopoly status and technological moats in this field are unquestionable. As of the first quarter of 2026, SpaceX has successfully executed approximately 650 rocket launches in human history, with over 85% of those missions completed using reusable rocket boosters. In the recently concluded year of 2025, the total mass of payload delivered into Earth's orbit by SpaceX alone accounted for more than 80% of the entire world's total launch mass. The core reason it has utterly crushed Boeing, Lockheed Martin, and traditional national space agencies boils down to two words: cost efficiency. Let us look at a set of shocking comparative figures disclosed in the prospectus. In the past, the National Aeronautics and Space Administration, NASA, spent an average cost of up to $54,500 to send 1 kilogram of payload into low Earth orbit, LEO, using traditional space shuttles. Meanwhile, SpaceX's flagship workhorse, the Falcon 9, through its staggering launch success rate of over 99% and matured booster recovery technology, slashed this cost down to $2,720 per kilogram, a mere 1/20th of NASA's historical cost. Even more terrifying is the ultra-heavy lift launch vehicle currently undergoing intensive 5th and 6th high-altitude orbital testing, Starship V3. According to theoretical models predicted in the prospectus, once Starship achieves fully autonomous two-stage recovery, the chopsticks catching a rocket technology you see in videos, its LEO transport cost will collapse off a cliff to under $100 per kilogram. This is equivalent to slashing the price of humanity's ticket to space by 99%. Yet, despite being a department with unmatched global tech dominance that seemingly secures contracts effortlessly, bagging massive orders from the U.S. Department of Defense, the military, and NASA in 2025, its standalone financial statements shocked average investors. The prospectus reveals that, while the space segment's full-year revenue for 2025 exceeded $4 billion, its net income was a negative $657 million. The reason is straightforward. Rocket R&D, iterative Starship explosions, and complex deep space recovery trials constitute an incredibly brutal war of attrition. Therefore, the space business is SpaceX's technology engine, but it is absolutely not the company's profit engine. Since the rocket business doesn't make money, where on earth is the cold, hard cash supporting this nearly $2 trillion valuation coming from? The answer lies in the second major pillar: connectivity, better known to everyone as Starlink. The essence of Starlink is, in fact, the most successful internal commercialization monetization path of SpaceX's rocket business. Since I possess the cheapest rocket launch costs in the world, I might as well manufacture my own satellites, package and launch them myself, cover Earth's low orbit with tens of thousands of communication satellites, and transform directly into a globally dominant, space-based telecom operator. Prospectus data shows that in 2025, the Starlink segment's total revenue reached an astonishing $11.4 billion. More importantly, it achieved a massive $4.4 billion in net profit. This makes it the only division among SpaceX's three business segments to generate massive positive cash flow and net profits. Starlink's existence proves a vital fact to Wall Street investors. Musk's space dream is not just pie-in-the-sky corporate slide decks, nor is it a bottomless pit that can only survive on government subsidies and venture capital. It truly possesses incredible self-sustaining revenue generation capabilities. As of now, Starlink has developed millions of active subscribers around the world. In the blind areas that cannot be covered by traditional base stations such as aircraft, deep sea, and polar regions, Starlink can provide an extremely stable high-speed network, and the combination of monthly fees and equipment fees provides a very high average income per user, ARPU. It is safe to say that Starlink is the absolute backbone that allowed SpaceX to stand tall and demand a sky-high valuation from capital markets on the eve of its IPO. If SpaceX only relied on space and Starlink, its fair valuation in the eyes of Wall Street would top out between $300 billion and $500 billion to push its valuation straight onto a $1.7 trillion throne. Musk unveiled his ultimate masterstroke in the 2026 prospectus, formally merging his personal AI company, xAI, into the SpaceX-listed entity through an intricate equity swap, thereby forming the third major business segment, artificial intelligence, AI. Within these hundreds of pages of the prospectus, the most eye-catching and controversial element is a massive chart appearing right on the very first page of the main text. Musk introduces a financial metric called TAM, Total Addressable Market. He painted three visionary pies for investors. 1. Future TAM for the space segment, $370 billion. 2. Future TAM for the connectivity, Starlink segment, $1.6 trillion. 3. TAM for the intersection of AI and space, a terrifying $26.5 trillion. Wall Street was completely stunned upon seeing this chart. At this point, xAI's actual revenue for 2025 was merely $3.2 billion, though it did announce a staggering contract in May 2025, leasing part of the computing power from its Colossus super data center in Tennessee to AI unicorn Anthropic, pulling in a fixed $1.25 billion monthly rent until 2029. Yet, this is essentially just renting out computational capacity like commercial real estate. It has no direct technological overlap with the lofty concept of space-based AI. So, how exactly does Musk plan to devour this $26.5 trillion AI pie? The prospectus lays out two highly sci-fi pathways. Step 1. The $2.4 trillion orbital data centers. Starting in 2028, Musk plans to use Starship to blast hundreds of super servers packed with high-powered AI chips directly into Earth's orbit. These data centers will cruise through zero-gravity space, running entirely on endless juice from dense solar arrays and leveraging the near-absolute zero deep space temperatures for natural radiative cooling. This aims to permanently bypass the power grids and cooling bottlenecks plaguing terrestrial data centers. Step 2. The staggering $22.7 trillion enterprise applications and autonomous agents management. Page 176 of the prospectus uses incredibly dense academic and esoteric jargon to explain that future AI, by automating daily cognitive tasks, will transform traditional knowledge workers into empowered managers of autonomous AI agents, unleashing unprecedented levels of productivity. To put it bluntly, Musk is saying, you won't need to go to work in the future. My space-based AI data centers and ground-based Optimus robots will form an army of autonomous agents to work for all of humanity. And the control of this ecosystem lies entirely in SpaceX's hands. Each of these words can be recognized when opened, and the connection is simply confusing. Yet, that is the beauty of the capital markets. Space acts as the bedrock, Starlink prints the cash, and AI serves as the super propellant to launch the valuation into the stratosphere. Musk successfully hijacked the AI capital hype cycle, wrapping an asset-heavy, high-risk aerospace company into the world's largest monopoly on AI infrastructure. After understanding SpaceX's three main pillars, any smart investor will arrive at a glaring question. Musk has previously stated on countless public occasions that listing SpaceX prematurely would be an absolute disaster. So why, in the year 2026, did Musk abruptly reverse his stance and push through the largest IPO in human history with such thunderous force? This is not just because space dreams need money is so simple. In the in-depth analysis of the prospectus, we learned that the most secret debt transfer game of Wall Street's senior management has been learned. The origin of this financial game traces back 4 years. In 2022, Musk spectacularly and forcefully acquired social media giant Twitter, later renamed X, for $44 billion. In this acquisition, Musk didn't shell out all cash. Instead, he borrowed a massive $12.5 billion in leveraged buyout loans from a consortium of Wall Street's top investment banks, including Morgan Stanley and Bank of America. As X Corporation subsequently suffered a wave of advertiser exoduses and valuation collapses, this $12.5 billion debt became the nastiest bad loan sitting on the balance sheets of Wall Street's largest banks, dragging on as one of the longest and most painful hung buyout debts in Wall Street history. However, Musk's masterclass in capital engineering was displayed flawlessly over the next 2 years. Step 1, 2025. Musk's rapidly appreciating AI darling, XAI, announced the formal acquisition of the social media platform X. As a cost of this acquisition, that legendary $12.5 billion Wall Street debt strapped to X Corp was legitimately inherited by XAI. Step 2. On the eve of the 2026 IPO, the parent company, SpaceX, announced a comprehensive merger with XAI via an all-stock asset swap. Consequently, this $12.5 billion legacy debt that originated with Twitter and passed through XAI, combined with XAI's own $5 billion new debt accrued to buy H100/B200 chips and build data centers, totaling a complex $17.5 billion debt bundle, ended up landing entirely squarely on the shoulders of SpaceX, the ultimate cash cow. Step 3. Bridging with a bridge loan. To clean up its balance sheet prior to listing so retail investors wouldn't be greeted by a mountain of toxic debt, SpaceX applied to the Wall Street banking syndicate for a massive $20 billion short-term bridge loan. SpaceX utilized this bridge loan to clear out every single high-interest legacy debt belonging to Twitter and XAI in one fell swoop ahead of schedule. So, who ultimately foots the bill for this $20 billion short-term bridge loan? The answer is precisely this IPO. SpaceX successfully raised $75 billion in cash from the global market through its listing. As this capital poured into the company accounts, the absolute first order of business was to completely wipe clean this $20 billion bridge loan. This is a classic interlocking capital shell game. The money Musk borrowed from banks to buy Twitter years ago, through a brilliant series of nested subsidiary mergers, ultimately transformed into the liabilities of the SpaceX public entity and was grandiosely dumped onto public U.S. stock investors and open market institutions who paid cold, hard cash to take the hit. In this massive debt relocation, the most ecstatic parties were none other than the elite Wall Street investment banking cartel led by Morgan Stanley. Back then, they spent every waking hour sweating bullets over the $12.5 billion they lent Musk to buy Twitter, terrified it would decay into unrecoverable toxic debt on their books. This time around, the roster for SpaceX's bridge loan was pure luxury. Goldman Sachs, Bank of America, Citigroup, JP Morgan Chase, and Morgan Stanley. Why were these sharpest minds on Wall Street tripping over each other to extend this highly risky $20 billion short-term loan to SpaceX? Because the bridge loan was merely the appetizer. The true gluttonous feast was the subsequent $75 billion underwriting contract, the largest IPO in human history. Ultimately, a whopping 21 global top-tier banks crowded into SpaceX's underwriting syndicate. The bulge bracket banks, sitting in the front row as lead underwriters, not only successfully staged a clean getaway from their historical Twitter toxic debt, but also raked in billions of dollars in astronomical underwriting fees and commissions simply by slinging SPCX stock. There is no such thing as a free lunch. Behind the frantic cheerleading and sky-high valuation pumping by Wall Street firms on the eve of the listing lay nothing but raw, naked financial collusion. In capital markets, once a company raises $75 billion from the public, the founder's equity and control are typically diluted to near insignificance. However, Elon Musk is a battle-hardened, ruthless character who was once callously ousted by the board at PayPal, marginalized at OpenAI, and had to resort to holding Tesla hostage with resignation threats just to secure more stock. Having learned his lessons the hard way, he demonstrated an absolute psychological obsession with control in designing SpaceX's equity architecture, borders on the pathological. To maintain absolute, privatized dominion over the company even after it transformed into a public entity, Musk instituted an extremely radical multi-class share structure inside SpaceX. SpaceX's common stock was aggressively fractured into 3 distinct tiers. Class A shares, 1 vote per share. The shares floated to the public, retail buyers, and standard institutions to raise the $75 billion were exclusively Class A. Class B shares, 10 votes per share. This is the holy of holies. Class C shares, 0 votes per share. Pure passive dividend tracking vehicles with 0 say in governance. According to staggering data disclosed in the prospectus prior to this official IPO listing, while Musk personally held a meager 12.3% of Class A shares, he locked down an ironclad 93.6% of the company's Class B shares. Through this dual-class voting megaphone, Musk wielded a supreme 85.1% absolute voting control over SpaceX before going public. What's more, even if a large number of shares were diluted to the outside world in this IPO, after careful calculation, it was found that after the completion of the listing, the super voting rights in Musk's hands only decreased slightly from 85.1% to 84%. On top of that, SpaceX explicitly stated in black and white in its SEC-filed charter, Class B shareholders possess the direct right to appoint and control more than half of the seats on the board of directors. This means that no matter how many subsequent rounds of Class A financing SpaceX conducts on the open market, or how many mega institutions buy in, even if Musk's economic stake drops to 1%, he can still single-handedly veto any joint institutional proposal utilizing his Class B supervoting power and board immunity clauses. On day 1 of trading, 3 major U.S. public pension funds issued a stern, joint, civil warning, bashing SpaceX's governance model as an unprecedented, highly extreme blueprint for corporate autocracy in the history of the U.S. stock market. If the Class A/B setup is just a routine defensive mode on Wall Street, the founder's 4th-round moonshot incentive program, hidden deep on page 235 of the prospectus, gives everyone a masterclass in textbook capital extraction out of thin air. To incentivize Musk, the SpaceX board custom-tailored an incentive architecture split into 2 extreme milestone targets, the Space Edition and the AI Edition. Let's examine this detailed breakdown to see just how detached from reality the board's corporate KPIs are. Whether it's populating Mars with 1 million people overnight or generating 100 terawatts of compute in outer space, both sound like pure fantasy under current technological bounds. To put it in perspective, the entire current annualized power consumption of the human race across the globe hovers around just 3 terawatts, TW. For Musk to conjure up a space-based AI data center in the sky representing 33 times the current total power draw of Earth is simply an impossible task for humanity in the 21st century. Since these metrics are so absurd, why did the board bother putting them in black and white in the prospectus? Was it just to fill up pages? There is such a most deadly line of small words in the densely attached micro-clauses, footnotes, of the prospectus. The participant of the aforementioned incentive plan, Elon Musk, from the date of grant of the restricted stock options by the board, shall immediately enjoy all rights and privileges of a Class B shareholder corresponding to such shares, including but not limited to voting rights. The cat is out of the bag. This grand total of 1,320,728,500 shares of Superclass B stock cannot be liquidated or cashed out by Musk before the technical goals are met, but their 10 times voting weight was unconditionally handed over to Musk from the exact second the prospectus was signed. This isn't an extreme corporate milestone plan, it is a blatant, orchestrated scheme cooked up by the board on the eve of listing to gift the boss an absolute monopoly of Iron Throne voting rights under the guise of an impossible sci-fi mission. Cloaked in the armor of unachievable sci-fi fantasies, Musk effortlessly bolted his throne shut with 10,000 iron padlocks. Given that SpaceX commands the pinnacle of human aerospace tech, Starlink is printing money, and Musk wrapped the asset portfolio in such an incredibly sexy narrative via corporate wizardry, why did SPCX suffer a devastating 16% single-day crash and a brutal 30% plus peak-to-trough wipeout within 2 weeks of listing? What fatal vulnerabilities did Wall Street short sellers and sober analysts spot amidst this cosmic capital carnival? The immediate match that lit this black swan sell-off was a jaw-dropping decision SpaceX executed right on the heels of successfully vacuuming up $75 billion in the IPO. In mid-June, just days after ringing the opening bell, verified reports emerged on Wall Street that SpaceX planned to execute its inaugural open market issuance of up to $20 billion in investment-grade unsecured corporate bonds. This stunt instantly enraged the massive cohorts of retail and institutional investors who had just bought the top. The market simply couldn't comprehend. You literally just secured a mountain of $75 billion in cash courtesy of global equity investors through the IPO. Why, before your feet are even dry, are you scrambling back to the credit markets begging for another $20 billion? Fixed income analysts on Wall Street immediately ran the numbers. In the current macroeconomic environment of elevated interest rates, even with SpaceX's stellar credit profile, this $20 billion unsecured bond pile will generate at least $1 billion to $1.2 billion in rigid, annualized interest expenses. Layered on top of the massive interest payments inherited from shifting the legacy debts of Twitter and XAI, SpaceX's books were instantly crushed by a mountain of financing costs. Panic rippled through the market over fears that these astronomical debt service payments would completely swallow up the $4.4 billion in net profit that Starlink worked so tirelessly to generate. As the meticulous financial details in the hundreds of pages of the prospectus, the S-1 filing, were audited line by line under institutional magnifying glasses, the true burn rate of SpaceX post-XAI merger was finally dragged into the light. According to the newly disclosed audited financial metrics, for the full year of 2025, the total capital expenditure, CapEx, of the SpaceX consolidated entity reached a staggering $20.737 billion. In the first quarter of 2026 alone, to panic buy the latest generation of NVIDIA B200 chips for XAI and lock down premium energy grid capacity for data centers, the company's total capital outlay exploded to $10.107 billion. Profitability-wise, because the AI division voraciously incinerated $12.7 billion in 2025 on silicon and infrastructure buildouts, SpaceX's consolidated net loss for 2025 widened to a gaping $4.9 billion. In a flash, investors woke up to reality. The XAI package stuffed into the company by Musk is currently nowhere near a highly lucrative cash cow. It is a supermassive black hole consuming cash by the minute. It not only vaporized every cent of Starlink's earnings, but forced the parent company into public listings and high-frequency debt issuance just to keep running an ongoing corporate blood transfusion. This high-wire financial engineering spooked the megalong-only asset managers like Vanguard and BlackRock, accustomed to stable returns, prompting them to lock in profits and flee. On a financial engineering level, the reason SPCX's stock price behaved like such an extreme roller coaster boils down heavily to an artificial liquidity starvation engineered by Musk during the initial listing phase. Despite commanding a $1.77 trillion valuation, the actual free float made available in the SpaceX IPO was less than 5%. This is structurally identical to cutting a pinhole-sized opening on a colossal water dam. During the opening days, as waves of retail euphoria and buy orders crashed in, the absolute scarcity of tradable float allowed a handful of large block orders to easily squeeze the price to an all-time high of $200 $25. Yet this highly concentrated float structure is a deadly, double-edged sword. The moment the broader tech sector corrects and a few institutions lock in gains, the absolute absence of historical order book depth to absorb the selling sends the stock into a cascading, domino-like freefall off a cliff. Making matters worse, under the early release provisions in the prospectus, an additional 10% of shares locked up by employees and early VCs was scheduled for early release provided the stock could sustain a level above 130% of the IPO price, or $175.5. However, because this ruthless two-week crash cleanly punctured right through that critical 175.5 red line, the early unlock plan was completely derailed, shattering employee hopes of cashing out and sparking a wave of internal morale friction. The market's true day of reckoning looms just ahead in August and September 2026 when the standard lockup periods expire for the massive cohorts of early-stage top-tier VCs and legacy shareholders who did not participate in the IPO. When that day arrives, a tidal wave of unlocked equity will flood the open market. Anticipating this colossal impending supply shock, smart money chose to exit early, further exacerbating the ongoing avalanche. Looking at the macro cycle, the SpaceX sell-off is not an isolated event. It is the central epicenter of the broader AI de-risking tempest sweeping Silicon Valley in mid-2026. Over the past 24 months, Wall Street's favorite game was circular capital recycling. Microsoft funds OpenAI, and OpenAI turns around and uses that cash to buy Microsoft Azure Compute. Musk uses SpaceX credit to feed xAI, and xAI announces massive compute lease contracts back to the mothership. This left-hand to right-hand shell game works like magic in a bull market, sending valuations screaming into the stratosphere like a rocket. But by June 2026, global macro indicators softened and tech behemoths, including NVIDIA, Google, and Meta, had dumped hundreds of billions into AI infrastructure without seeing those outlays translate into explosive net income growth on the software application layer. Wall Street's patience ran thin, triggering a collective asset repricing. As a result, SPCX, which strapped space and AI, the two most capital-intensive, narrative-heavy sectors, onto the very same rocket ship, became the absolute favorite target for macro short sellers. Having mapped out the entire financial labyrinth surrounding SpaceX's IPO, we must admit that Elon Musk is undeniably the most unparalleled business prodigy and financial illusionist of our era. He spent 2 decades converting booster recovery, a concept humanity long dismissed as pure science fiction, into a routine industrial assembly line reality. He deployed Starlink to hook up millions of users in the deep oceans and polar extremities. These technological breakthroughs and civilizational contributions are entirely real and impossible to erase. Yet, the Wall Street financial theater he conducted using this colossal halo is equally raw and transactional. He, through a blinding array of daisy-chained corporate acquisitions, successfully packaged Twitter's bad debts and xAI's cash incinerator into a $2 trillion ultimate cosmic tech conglomerate, ultimately positioning retail investors and open market public funds as the final bags holders for this staggering debt pile. The capital markets have never believed in tears. While ecstatic retail buyers were weeping tears of joy over epic footage of mechanical arms catching a rocket, aggressively chasing the stock at $220 while shouting, "For Mars!" Wall Street elites, lockstep with their banking syndicates, were quietly executing the cleanest and largest high-level exit and debt liquidation in financial history. This devastating 30% pullback is simply the capital market's cold, calculated way of forcing a margin call on this cosmic carnival. Nevertheless, Musk's main character armor and his core legion of loyalists remain a formidable floor supporting the company. On that darkest Monday, when the stock tanked 16%, the queen of tech, Cathie Wood's ARK Invest, moved decisively. Deploying capital across 4 flagship funds, she spent $32.5 million swimming against the current to scoop up 32.9 million shares of SPCX on the cheap. putting real money down to buy the dip and recharge the Musk narrative. A sky-high valuation has always been a double-edged sword. In the beginning, it allowed SpaceX to dilute a minuscule 4.2% of its equity to effortlessly extract a historic $75 billion war chest, giving the firm immense runway to weather the Starship Phi-3 dev cycles and orbital data center cooling bottlenecks. But it simultaneously pulled forward and exhausted decades' worth of commercial upside and imagination. A founder's personal brand equity can underwrite a narrative for a while, but it cannot write checks to cover massive bond interest payments forever. The eyes of the global financial elite are now squarely locked on the impending earnings report, dropping on August 6, 2026. This will mark SpaceX's first official quarterly financial report card since engulfing xAI and executing its epoch-making IPO. When that clock strikes, Musk must deliver clean, uninflated quarterly profits and underlying cash flow metrics to prove to Wall Street whether his deep space AI narrative can actually manifest as real profit. If that print misses and the critical psychological line in the sand, the $135 IPO issue price, breaks, this grandest aerospace capital theater in human history will face a brutal, earth-shattering liquidation. Where do you see SpaceX 3 years from now? Will it emerge as a multi-trillion-dollar cosmic juggernaut like NVIDIA, ruling humanity's AI infrastructure? Or will it go down as the largest spectacular bubble in stock market history, punctured by a broken chain of debt? Drop your most hardcore theories in the comments section below. Thanks for watching, and we'll see you in the next video.